with money trap number 1, a 50-year mortgage. Buying a house or even a shack is expensive. And to combat these high home prices and high mortgage payments, the Trump administration has proposed a 50-year mortgage. That way you can have lower mortgage payments. Let me show you why that's a bad idea. You want to buy this $400,000 house right here. You put 20% down and you can get a 30-year fixed rate mortgage at 6.5%. Well, that means your monthly mortgage payment just on the mortgage is going to cost you $2,022 a month, which means over the 30 years, you are going to pay $400,000 to buy the house plus an additional $408,000 in interest over the course of 30 years. But take a look what happens if you were to extend your mortgage over 50 years. With a 50-year mortgage, assuming that you get the same interest rate, and generally your mortgage rate actually goes up the longer your mortgage is, but I'm going to assume you get the same 6.5% rate. Well, now your monthly mortgage payment is going to drop by a couple $100 to $1,803. But now what's going to happen is you're going to pay the $400,000 to buy the house, and then you're going to pay an additional $763,000 in interest. That means you're going to pay $350-some thousand extra in interest for the extra 20 years of your mortgage. So here you paid $808,000 for the house. Here you paid $1.16 million to buy the house. Money trap number 2 is all invest when the markets cool down. The stock market is near record highs right now, and some people are concerned about a stock market bubble, particularly with AI and tech stocks. And this is where some people are naturally going to say, I'm not going to invest my money until the market crashes. Well, there's 2 things I want you to know. Number 1 is that a market crash is always coming. We always have a recession coming. Over the last 100 years, we have seen 16 recessions. That means we've averaged more than 1 recession per decade over the last 100 years. We know that a market crash is coming. We know that a recession is coming. We just don't know when. It could be next year. It could be 10 years from now. We don't know. The second thing is that market crashes and recessions create more millionaires than any other time because they create great buying opportunities. But like Warren Buffett says, time in the market beats time ing the market. You can keep some money on the side for when the market crashes, for when the recession happens, that way you can capitalize on it. But what's been proven throughout history is that waiting is often a losing game. And this is one of the simplest ways for you to start investing, which I can't tell you to do because, of course, I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But one of the simplest ways to start investing is just to follow a strategy that I call ABB. Always be buying. This has been a strategy proven to win, proven to build wealth over the long term. And the way it works is you just invest your money into the broad market. Say the S&P 500. There are funds out there called ETFs, also index funds, which can give you exposure to the S&P 500. I'll give you a couple examples. I can't tell you what to invest in, but SPY, SPY. This gives you exposure to the S&P 500. If you buy 1 share of SPY on whatever brokerage you have, you're going to essentially get exposure to the 500 largest companies in the stock market. If you want to be a little bit more broad, VTI gives you exposure to the total stock market, the 2,000 some stocks in the stock market. But if you want to get even more niche, QQQ gives you exposure to the NASDAQ 100. This is the 100 largest companies in the stock market that are not financial, so primarily tech. This is also the most volatile. When you have downturns, this one gets hit the hardest. But now the way that you win, ABB, set up a system every week, every 2 weeks, or every month. You pick which one, doesn't really matter. You set up a system every week, every 2 weeks, every month, money leaves your bank account and it's going to be invested into whatever passive investment or investments you want, and then you don't touch it. That means when markets go up, you keep buying. Markets go down, you keep buying. You go to a recession, you keep buying. You go to an economic boom, you keep buying. It's a Democrat in the White House, you buy. Republican in the White House, you buy. You have a dog, you buy. You have a cat, you buy. You don't have a pet, you buy. You can't afford the guac, you keep buying. That's how you win with the strategy. The A is always, and if you do that, it's been proven to win over the long term. Now, there are ways for you to get a little bit more advanced with their investments. If you want to find investments where the money is moving, you want to do that research. I'm not going to go over all that in this video, but I do have a free masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before they hit the headlines. I'll show you the exact framework that my firm and I use to research investment opportunities, again, before they hit the headlines. So if you want to get the investing masterclass, all you have to do is register. And when you register, you're also going to get access to Market Briefs, which is my newsletter for investors, completely free, complimentary as a bonus. So if you want to get the Investing Masterclass and Market Briefs all for free, all you have to do is register, and I have the link for you down in the description below. Trap number 3 is financing a car. Right now, the majority of Americans do not have $1,000 saved up to protect them against an emergency, yet we have a record high number of people paying $1,000 a month for a car, while the average new car payment is $749 a month. Your car is a triple whammy. It is a depreciating liability. As soon as you stick your keys in the ignition, that car is going to lose value. Number 2, you're going to be paying interest on this thing that's losing value. And number 3, it has a limited lifespan. So you might end up paying interest on a car after you finish driving it. Now let's do a little comparison. You're paying $749 a month to buy this car, plus the premium gas, plus the insurance, plus the maintenance. So it's going to cost you $1,000 a month, but let's just stick with $749. After 25 years of you paying $749 a month for this car, your car is going to be worth about $0. If you take the $749 and you just throw it into the markets and you get the average market return, 10% a year, you're not trying to find any good stocks, you're just putting your money into the markets. Well, now, after 25 years, you're going to have $1 million. After 30 years, your car is going to be worth, again, $0. Your investments are going to grow to $1.6 million. You finance the car for $749. After 40 years, you're going to have, well, let me do some math, $0. If you invest that money for 40 years, you're going to have $4.4 million. You pick which one you want. The time is going to go, do you want to be broke? Do you want to be wealthy? You pick. Now you're going to say, well, Jaspreet, I need a car to get to and from work. You're right. When you finance this car, you put $8,000 to $12,000 down. Take that down payment, $8,000 to $12,000. Get yourself a nice Toyota Corolla, Toyota Camry, Honda Accord. Pay it with cash. You got a good working car. It's not the premium insurance. It's not the premium gas. But you got a nice car. And then you can build your wealth, buy whatever car you want then. Because now, guess what? You can buy the BMW, you can buy the Mercedes, you can buy the Lamborghini. You can buy it with cash, you don't gotta worry about the price. Number 4 is not studying AI. The CEO of Walmart, the largest private employer in the world, recently announced a 3-year hiring freeze because of AI. On top of that, getting an entry-level job has become so much more difficult because we can automate a lot of those basic tasks with AI. And if that's not enough reason for you to start learning about AI, let me tell you a personal story. I ran a company called Briefs Media. We were doing very well, but then as I started to learn more and more about AI, it became very clear to me that, oh crap, if we keep doing what we're doing, which is publishing financial news, publishing investment research, we're going to be bankrupt by 2035. Then I started doing some more digging and learning, and I realized, oh, we're not going to be bankrupt by 2035, we're going to be bankrupt by 2030 because we won't be able to just compete with AI. So we made a full company pivot. Now we're going to be transitioning to Briefs Finance as a fintech company, a financial technology company powered by media, and we've put a ton of energy, effort, resources, money, time into building a new AI software tool to help investors make better investments. It took a lot of work and energy, but if we didn't make that switch, we probably wouldn't be in business for very long. So, if you have not started learning how AI works, this is the time to do so, not just in your career, your investments, anywhere to help you be better with money. And there are 3 things that you can consider learning. Number 1 is learn about prompting. Take a class about prompting, watch YouTube videos on prompting. Everything with AI today is all about how do you ask the right question. The better questions you ask, the better outputs you're going to get. Number 2 is how can you increase your output and efficiency from your job or your business. It doesn't matter what skill, what degree, what job you work, figure out how you can use AI in your job, in your business. And if you don't know, just go to ChatGPT, tell it what you do, and ask it how you can use AI to be more efficient, because before you get replaced with AI, you're going to be replaced by somebody who understands AI, because that understanding of AI is going to allow you to do your job much better. And number 3 is, of course, as an investor, you want to think about, could this improve your investment decisions? Are you investing in companies that are utilizing AI? Are you investing in companies that are able to be more productive, able to be more efficient, able to grow their profits? Because if that company that you're investing in is not, it might be replaced by a company that is getting more efficient, that is getting more productive through its use of technology. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.